Today, again, thanks for joining us in what's our fifth session since March. Today, we're going to try and have a bit more of a focus on what's happening in the demand recovery. We'll start off, as ever, looking at the oil supply side, because that still is kind of crucial to what's happening in the broader oil and products markets, and key in terms of the kind of the macroeconomic environment as well. But then we'll shift into Asian products, Asian refinery activity, before finishing off with a look at LNG and dry bulk markets as well, trying to look to see what we can ascertain in terms of what's happening in the broader economic environment from those. So I will hand you over now to Omayun, who's going to be looking first at what's happening in the broader crude supply situation.
Thank you, Alex. Thank you, Arthur, for the introduction. So indeed, in this first part, we are going to focus on our latest views around global oil supply. We're going to take a deeper look at OPEC Plus, at the US, and basically we are going to see that, yes, there has been a huge decline in supply, which I'm sure you would have noticed anyways, given the recent oil price increase. However, we also see that this doesn't translate into inventories declining yet. So we actually see inventories continue to build up. Last time we showed you the first version of our new OPEC Plus compliance indicator. The indicator works by taking variations in oil exports as well as changes that we see in onshore storage tanks, whether that's at refineries or facilities that can be considered as SPRs, strategic petroleum reserves. So while the OPEC Plus pledged a 9.7 million barrel per day cut in May, we estimate there's been a cut of 8.1 million barrel per day, which equals to a compliance of around 83% for OPEC Plus as a whole. Obviously, that number isn't the same for each country. So here we can categorize them in three main sections. First of all, there's been high compliance among most of the main producers. The OPEC Plus leaders, Saudi Arabia and Russia, namely, but also countries such as Kuwait and Kazakhstan. It's worth noting that both Saudi Arabia and Kuwait are already at levels that they pledged they will be for the whole month of June, as they had actually imposed an additional self-imposed cut of 1 million barrels per day for Saudi Arabia and 80,000 barrels per day for Kuwait. So they're basically already at these levels. Then you get some big producers that are still far off their targets. And here's the interesting point. So in the media, you get a focus mostly on Nigeria and Iraq. However, we see that other countries such as the UAE and Oman are also quite far from their target. Now, the interesting point is related to the reference number that is used by OPEC Plus countries. So while Saudi Arabia and Russia are using a reference production number of 11 million barrels per day, so that's a hardline number, the UAE's reference production is based on October 2018 production levels. So while we have actually seen a big monthly decline out of the UAE in terms of exports, so we saw an export decline of 800,000 barrels per day out of the UAE. If you base that against October 2018 levels, you actually reach a decrease of only 400,000 barrels per day. So hence our compliance level of only 56% for the UAE. Now, finally, the last group consists mostly of smaller producers, countries like Gabon, Equatorial Guinea, Congo, Sudan, who basically are continuing life as is. We actually saw some decline in their exports in May, but there's been a bump recently as oil prices edged higher. So in total, their compliance is pretty minimal. Now, on the second slide, we take a deeper look at Saudi Arabia's position, not specifically looking at its oil production, but more around its de facto role as the OPEC Plus leader. So the graph you see on the right shows you the total foreign cash reserves that the kingdom has. So that's the blue line that you see. That's based on the on the left axis in $1 million. And the columns show you the monthly changes. So as you can see, reserves had crashed between the second half of 2014 and end 2016 as a result of the oil price crash back then. Then with the implementation of OPEC cuts since the end of 2016, Saudi Arabia was able to stabilize its foreign reserves. But now it has taken the southern route again since February, and we just saw the two biggest monthly declines in March and in April. So in just the past 3 months, that's about $50 billion, or about 10% of the country's foreign reserves that have vanished. Now, part of the decrease is explained by a transfer that the country made towards its sovereign wealth fund. So there was a $40 billion transfer to the sovereign wealth fund, and the goal was to bet on stocks beaten down by the coronavirus pandemic, so stocks such as Facebook or Apple. But nonetheless, this shows that the country didn't build its reserves in April, despite it producing at an all-time high level. So in April, exports averaged around 9.6 million barrels per day, and despite that high number, the country was not able to build its foreign reserves. So the main number will be absolutely key to assess how strong Saudi's position is, and basically how long they can afford to keep exports that low. So at the moment, exports are around 6 million barrels per day, and in the month of July, their pledge is going to decrease by 1 million barrels per day. So they could technically increase production and exports by 1 million barrels per day. Now, moving away from OPEC+, there's another place where there has been a lot of production cuts, and that's actually the U.S. So exports had held strong until now, but we're currently seeing a big monthly decline in June so far. So that's about 1 million barrels per day less on a year-on-year basis compared to June last year. Total exports out of the U.S. actually had reached 3.4 million barrels per day in December, and they're now down to just 2 million barrels per day, around 2 million barrels per day. So in total, that's about a 1.5 million barrels per day fall in the past 6 months. So this is really driven by the impact of low oil prices on shale oil operations. The shale oil was the reason for the increase in U.S. oil production and export, and this is the blue line that you see here. So that's the exports out of the U.S. But now shale oil production is now the reason for the decrease. So in the first quarter of the year, the shale sector accounted for about half of the U.S. oil exports. Now, obviously, shale players are very sensitive to the oil price. So most of them are still pure players. They're not integrated. Many companies are still very small. U.S. shale production actually fell 1 million barrels per day in May compared to a year ago, and we are starting to see the impact on the country's exports. And this was mainly driven by declines in the Permian and the Bakken basins. Now, that may change as oil prices are starting to rebound. So there are already some positive signals. Some companies like EOG Resources mentioned that they are able to stabilize their production at $30 a barrel, and they can actually increase production when prices get above $40 a barrel. During that period of low oil prices, there's actually been a lot of new wells that were drilled but not completed. So that's about nearly 800 new wells that have been drilled and have been added to the inventories of drilled but uncompleted wells, those DUCs. So in total, that's about 5,000 DUCs in the country. And that's quite an unusual process to see an increase of uncompleted wells in the spring and the summer. Normally this level decreases at that time of the year. Now, what this means is that shale companies are trying to optimize their portfolio of wells. And as a reminder, a large part of the return of a shale oil well takes place at the beginning of production. So the sensitivity to the oil price is extremely high, especially in the first few months of production, as production quickly declines. So a lot of players are pushing back first production from these wells in order to manage their cash flows and in order to get higher return from each well in the future. So this means that, according to us, production is expected to bounce back sometime in second half of the year. So how does this lower global oil supply translate into the world of storage? Well, that's the thing. Despite this fall in supply, we still see inventories building throughout the world, both onshore and offshore. So onshore storage is building at an even higher rate than in May. So if we look at the month of June, we're already 25 million barrels higher on the month, and we're only halfway through the month of June. So a lot of this additional oil that gets stored goes to Eastern Asia. So Eastern Asia countries like China, Japan, and South Korea really are able to take more oil. This goes into the storage for longer-term needs. And also the other key point is that while oil on water has been decreasing as a result of declining supply, floating storage actually continues to build as well, and that's also higher, about 25 million barrels compared to early May. So there's still a lot of oil.
Now, as we all know, the title of our webinar today is Asia Leads the Way in Demand Recovery. But in actual fact, there's quite a disparity across the region, both in terms of the rate of recovery and in terms of the actual responses of the regimes and the governments across the region. If we can move on to my first slide. We've taken two countries as an example of the disparity of response and therefore of recovery. And those two countries are Indonesia and Vietnam. Now, taking Indonesia first, Indonesia has actually not implemented a complete lockdown. It implemented a partial lockdown in major population centers and big cities on around the 22nd of April. But until that point, Indonesians were able to go about their business and life carried on pretty much as normal all the way through January, February, March, and into April itself. And that can be seen in the top chart here, the net oil imports. Indonesian numbers were still very strong in the first 4 months of the year. And then they fell off a cliff as we went into May. The lockdown was implemented and Indonesia actually became a net exporter, i.e. negative oil imports. On the other side of that spectrum of disparity in terms of implementation and measures to fight off the pandemic was Vietnam. Now, Vietnam recorded the first case of COVID outside China at the end of January or very early February. And Vietnam has experience of being the first country to witness a case outside China. The same thing happened in 2003 with SARS. Now, because of that experience, Vietnam implemented a very strict and very swift lockdown in very early February. Because of the makeup of the regime, it was possible, and the country, it was possible for the government to effectively use the military to enforce curfews in Ho Chi Minh, Hanoi, Da Nang, and other big cities. Now, that had a devastating impact on industrial activity, personal transportation and mobility, and therefore demand for clean products. And that translates into significantly reduced clean product imports. However, because of the swiftness and the robustness or rigidity of that lockdown, Vietnam came through the pandemic and the coronavirus sort of crisis relatively scot-free. Something like 300, 350 countries across a nation of 90 million people is really quite impressive. Now, because of that very strict discipline, Vietnam was then able to ease the lockdown much more quickly. So what we see going into May is a very rapid recovery in clean product imports, predominantly gas oil, but also some gasoline. And that's continued into June. What we're seeing in June is actually a return to pre-COVID levels of CPP imports. So really Vietnam is sort of leading the way and has become the poster child for coronavirus management. On my next slide, thank you very much. We're going to continue a theme that we started last month, and that was looking at the impact on the petrochemical market. And it's really because the petrochemical market gives you signals around what the macroeconomy is doing on a wider basis. And as we know, going into January, into early February, we were tracking previous year's naphtha imports into East Asia. And by East Asia, we mean China, Japan, South Korea, and Taiwan, the major petrochemical sort of powerhouses of the Asian region. So going into February, we were pretty much in line with previous years. And then we started to see a drop-off. Now, going through March, the peak of the coronavirus crisis, you'd expect that Chinese imports had obviously dropped off, and they had. Chinese refinery runs, however, started to increase in April and into May. So the demand for Chinese naphtha was relatively strong, but the demand for imports had come off. The story in May, therefore, switched over to one of the other big importers of the region, which is South Korea. And South Korean imports actually in May reached 713,000 barrels per day. That was up by 112,000 barrels per day versus April. And if you remember, Korea had a very strong response to the pandemic right at the very start, but was still coming out of their measures in March and April, and therefore we expected to see that rebound in May. June is likely to be around 550,000 barrels per day, and we expect that to continue going into the third quarter, i.e. a return to relatively normal cracking activity. Now on my next slide, we look at LPG imports, another major aspect of the petrochemical world. And what we can see here, again, we're sort of tracking along with the other markets through the early part of the year. The impact of the virus was felt in China and in Korea, but perhaps less so in other parts of the region. However, as we progress through March and into April and May, we see sudden increases in LPG import. What drove that? Well, predominantly, it was propane dehydrogenation. Propane imports in China picked up by 45% from 903,000 tonnes to 1.3 million tonnes between March and April. Now that PDH is normally associated with raw materials for things like kettles and remote controls and televisions and so on, i.e. generally consumer products made from plastic. But actually, if you scrape beneath the surface a little bit further, you can see that a lot of the PDH products, the polypropylenes and the polyethylenes, are used in the production of personal protective equipment. To give you an example of how wide the scope of that is, before the coronavirus crisis started, China produced something like 50% of the world's respiratory masks or respirators. And over the course of the crisis, they increased their output by 1,200% or 12 times. At the same time, just to give you another example of the importance of PPE and how it's really driving that PDH and petrochemical activity, 60% of the world's protective medical garments come from China. 51% of the world's medical goggles come from China. So it really can't be underestimated the importance that PPE is playing out, if you like, on PDH activity and therefore on propane imports. Japanese and Korea imports are resuming normal levels in May and June, and therefore we would expect the curve, the running sum curve that we show here, to carry on above previous years. Now in my next slide, I'm going to switch to Chinese imports in general. Now, as we all know, the first quarter of the year in China generally is very slow. It's Chinese New Year or Lunar New Year, but this year it was obviously compounded by the coronavirus-related shutdown or slowdown of Chinese refining activity and industrial activity in general. In fact, April imports of crude were down at 8.9 million barrels per day. May, however, is a different story. We've suddenly seen historically significant levels, 10.6 or so million barrels per day of imports. June is even higher, and we're seeing somewhere between 11.5 and 12 million barrels per day of imports as we go through the month. Now, at the same time, inventories rose very, very strongly between January and March. They then slowed into April, as we'd expect, with imports falling off. But we also saw a ramp up in refinery runs. 11% month on month in April really reflected some of the return of confidence and some of the recovery that China was starting to experience, and even more, 8.2% in May, recovering versus April. Now we're seeing a slight slowdown in June, simply because I think the product markets are struggling to absorb some of the output from those Chinese refineries. And on my next slide, could I have my next slide, please? There we go, thank you. On my next slide, we can see what's really happened on Chinese clean product exports. So we can see in April, could we go to the clean, yes, thank you. In April, we were at relatively normal levels, around about 1 million barrels a day of clean product exports. That was on the back of high refinery runs and limited demand within China itself. As we went into May, however, even though refinery runs stayed high, product exports fell. Now this begs a question: why did product exports fall when refinery runs have been high? Well, the simple reason is Chinese domestic retail prices, which are government controlled, were cut by around 25% versus the start of the year. But at the same time, crude feedstock prices had fallen by something close to 40%. So effectively, refiners were given a government protected incentive, a margin to run hard. Now, when the international market didn't want that product, we saw exports fall. So the exports had to go somewhere. And we believe that those exports have gone into clean product storage within China itself. Obviously, as those tertiary or those secondary and tertiary inventories start to build and storage facilities start to fill, China starts to look over to, abroad again and starts to look for export. And we're starting to see a recovery in those export levels again in June. Over 500,000 barrels, probably up to 600,000 barrels per day so far. But we expect that to normalize as refinery runs remain relatively high, but domestic demand remains relatively subdued. On my final slide, I wanted to look at the other major economy of this part of the world, and that's India. As we know, India implemented a relatively severe and strictly organized lockdown, but it was relatively late. And as a result, import levels remained high until March. We had figures around 4.5 million barrels per day in that particular month. They've subsequently fallen as industrial activity has really been curtailed and personal mobility has also been restricted. As we know, the stories of migrant workers being sent home to their villages, etc., are well publicized. Cities have been brought to a standstill, and even the Indian rail network is seeing less diesel demand than in the past. Some carriages have even been converted to hospital wards to cope with coronavirus patients. So crude imports have plummeted from 4.5 million barrels to 3.5 million barrels and less than 3 million barrels per day in June. At the same time, inventories have risen from about 90 million barrels in total in March up to over 110 million barrels in May. Of course, that's completely logical. It fits with the story. Imports are up, demand is down. We've got to put the oil somewhere, so it goes into storage. But we've started to see a draw in that now as we go through June. The imports are still low, but refineries are ramping up activity. So as you'd expect, the overall inventory level is starting to fall.
So, yeah, I'm going to be kind of beginning with a look at U.S. liquids markets as well as LNG departures, and then we're going to kind of flip over and look at Asian bulk demand. So first, looking at U.S. clean product exports, if you take a look at the graph to the right, you'll notice the orange is domestic demand for clean products as published by the EIA. And then the two lines are total exports and seaborne exports, and then CPP, total CPP exports, and then CPP exports to Latin America. You'll notice that the level of exports has managed to come back over the past several weeks, especially into June after bottoming out in mid-May. But this has not resulted in much of an uptick in departures towards Latin America. And this is certainly breaking from historical trend. One, you can see that the blue lines tend to track one another. And in 2019 alone, Latin America took nearly 70% of all US CPP volume. So it's notable that Latin America is not taking US clean products. And obviously this is driven by the issues in Brazil and elsewhere, given the lag in the coronavirus tending to hit the Southern Hemisphere later than the Northern Hemisphere. Now, kind of focusing back on the United States, you know, the demand picture as published by the EIA is mixed, right? So, you know, you'll notice clearly demand has rebounded. This was from early April. This is kind of a delineation between an initial pickup in demand for gasoline, although this gasoline demand has now kind of steadied at around 7.9 million barrels per day. And this is some 2 million barrels per day lower against year earlier levels. Middle distillates, which were slower to kind of tick higher and have been a bit more volatile, are up quite a bit as of the past 3 weeks, up by about 837 KBD, but this is still about 500 KBD under year earlier totals. So it's important to note that, some of the uptick in exports are just a product of improvements in refinery utilization and weakness in demand against historical levels. So the question moving forward, I think, is really, can gasoline demand come back into line against seasonal levels, which seems in doubt given the recent outbreaks we've seen, especially in southern states where you have a lot of gasoline demand. And the second piece is, can distillate demand, cover that 500 KBD gap I mentioned earlier? And that also remains in question. Obviously, that's going to be driven more by a broad-based economic recovery in the United States. So now we're going to look at global LNG markets, and we're going to wrap the United States into this question. Obviously, as we know, associated gas production in the United States has fallen quite a lot, and this has weighed on LNG exports. So if you'll take a look at the graph here, you'll notice the green bars are the year-over-year delta for total LNG exports globally. And you'll notice growth in departures has really pulled back a lot over the past few months. And this has been led by the United States. You'll notice, in just since May, departures are lower by more than 1.2 MT. And while we don't have it listed, U.S. departures for June are set to finish at under 2.5 MT. So the decline in LNG departures out of the United States is notable and clearly driving the decline in global LNG departures. And I have listed in this chart Qatari departures, which clearly have remained stable over this entire time series. And you can come to a similar conclusion when looking at Russian and Australian departures. These markets are relatively consistent and have not seen a lot of variation, especially an upward trend like the United States has seen up until the last few months. So I think LNG departures are very likely going to continue to struggle, given the fact that despite the fact that departures are down, or growth in departures have come back a little bit, we're still in an oversupplied market, and that's going to remain an issue. Now, we flip to the import side, and you'll notice in April and May, offtakes were okay seasonally. They were certainly off against February and March levels. Some of this decline is just a result of coming out of the winter months. But you'll notice a big drop off in June. And we believe this to be true because there was a lot of opportunistic buying in April and May because LNG prices were quite cheap. But you start to reach capacity limits and you start to reach levels, max levels in terms of purchasing. And so we've seen into June, import levels kind of come off a bit. So what all of this tells us is yes, the supply situation has improved, the oversupply situation has improved, but there are also issues on the import side. We're not seeing an uptick in imports, right? So I think there is still quite a bit of balancing yet to go. And obviously LNG markets are very new to dealing with oversupply problems. And so it's going to be interesting to see how this market evolves over the next few months. Now we move forward to bulk markets, and obviously related is first looking at thermal coal. You know, obviously China and India are the two big thermal coal importers. And if you look at your chart, you'll notice these are year-over-year changes in thermal coal imports. And you'll notice that beginning in May, both China and India started importing a lot less coal. And this was largely due to just weakness in thermal power output. While we don't have data for June, we do know in May, Chinese thermal output finished down 3% against year earlier levels, and India pretty unbelievably finished lower 21% year over year. So clearly, you know, current weakness into June is being driven by, it is likely just being driven by weakness in power output. It is important to note, especially in the case of China, in May, the country did undergo some coal to gas switching. So they did see a slight uptick in LNG arrivals in May that really weighed on coal imports quite a bit. This is not true for India. India has seen a cut in LNG and thermal coal imports since March. So I think when you look at this graph and you're trying to take in the broader picture, it's in general, both China and India have seen a decline in power output. Obviously, the problems in India are a lot more serious than China. And I think the issues in India especially could remain a problem for some time, given the fact that a lot of industrial output within India is going to struggle to come back online, whereas in China, a lot of that's going to be government driven, and they're going to force output online, whether it's economic or not, and that's not so true in India. Now, moving forward, obviously, to kind of build on this narrative of industrial output, we kind of wanted to look at iron ore, the iron ore market. There's been a lot of focus in this market in the past few weeks, especially since end May, when Brazil basically announced some production disruptions. Vale in particular announced a 10% shut-in as a result of the coronavirus. But you'll notice in aggregate, on the export side since February, aggregate departures have come off the lows that we saw. So in May, departures were at nearly 130 MT, quite a bit off the lows from February. And this was driven by China. Obviously, they consume most of the world's iron ore, but the key that we have been focusing on is this relationship between China and Australia. Trade tensions, obviously, as we all know, have really started to fray between the two countries. And this puts both countries at risk, especially when it comes to iron ore markets, because as I've mentioned here in the comments, in 2019, 67% of all iron ore arrivals into China were sourced from Australia. In other words, of the total Chinese imports, 67% came from Australia. And on the flip side, 81% of all Australian iron ore exports ended up in China. In other words, what does this say? China and Australia are very reliant upon one another for iron ore volumes, and this is not going to change anytime soon, assuming China wants to hold its iron ore consumption at relatively consistent levels. And so let's just run through a theoretical exercise here. If China wanted to shift demand away from Australia, it could reasonably shift maybe 270 MT per year away from Australia. But this would still force China to consume some 400 metric tons per year. And that's under the situation where every other producer on Earth ships all volume to China, right? Which is unlikely. So as you think and look at this market moving ahead, it's going to be very important to pay attention to the geopolitical relationship between China and Australia. And while it might seem that that China has a lot of the bargaining power in that relationship, in reality, China is very dependent on Australia for iron ore volumes. And so it's maybe not so unbalanced as one would initially think. And to kind of just build on this, obviously what I'm speaking on is long-term focus. In the short run, it's kind of ironic, but we're in a completely different situation. As I mentioned a bit earlier, Brazilian output disruptions in iron ore markets have helped to really buoy prices a lot. And this has really incentivized Australian iron ore exports. And you'll notice on a moving sum basis, 14-day moving sum basis, departures actually topped out at 40 MT early in June as a result of positive price action in iron ore markets. And just to note, and not listed here, we have seen departures come off a little bit, but it remains to be seen whether disruptions in Brazil could become more serious. At this point, the disruptions have been pretty small, but we'll see if problems could persist into the future. And this, in the short run, could provide an opportunity for Australian producers. So you have this interesting delineation between long-term concerns between Chinese-Australian relations and this kind of short-term opportunity. So with that, I'm going to hand it off to Alex. He's going to close it out and summarize.
Thanks, Reid. Yeah, so just quickly before we switch over to a few questions. So ultimately, yeah, on the crude supply side, the OPEC plus cuts have been significant as they needed to be. The real concern there, though, is that if Saudi eases back its additional its voluntary 1 million barrel a day cut at the end of this month, and the countries that haven't really been towing the line don't fall through, well, then we're going to see an increase in build in crude, considering that even despite these very steep cuts and kind of well-behaved broader producing countries, we have been building more than 1 million barrels a day for the last couple of months. Essentially, that is a real concern. On the demand side, yes, there are these pockets where you can point to very constructive stories, but our real concern still remains, and we've mentioned it before, that there is a rebound in activity in certain countries, but when you try to look at the broader global picture, it's very hard to see at this point in time a really strong recovery yet, basically. So then moving on into the other commodities, LNG, we mentioned the fact that you have this real price war brewing between Russia, Qatar and the United States. That seems to have been pushed back, but only really on the basis that the US has been cutting its exports for various reasons, be they economic or through associated gas production reasons as well. But the fact still remains that we have seen a decent increase in the number of vessels acting as floating storage over the course of the last week or so. And then on the dry bulks market, yes, iron ore is looking very strong. The demand in China, again, is supporting that market. But then when you look at thermal coal, it's essentially being battered on two fronts. One is the overall kind of power generation demand, and the other is the economic switching that's being offered or kind of coming against it from LNG. So there's still really not enough yet to say we're out of the woods, unsurprisingly, but hopefully there are some kind of good things to look out for in terms of some indicators for what we should be looking at. So I'll hand you over to Arthur and we'll take a few quick questions.
Yes, Alex, thank you. First question is for you, Alex, actually. What's the split in product types for Chinese exports?
So a very good question. I think one that is in the immediate time in terms of what we're seeing in the increase in exports in June is quite difficult because we're yet to see the kind of the full data picture. But so far we have seen exports kind of in line with the standard export slate, as it were, through June. So we're seeing a decent amount of gasoline, we're seeing diesel, gas oil. Unsurprisingly, there's kind of very low jet volumes. You really wouldn't expect to see that. That kind of production has been minimized. But a large number, the majority so far that we can ascertain what the product is coming out as kind of diesel and gas oil, basically.
Thank you, Alex. Another question for Humayun. Humayun, what's the U.S. LPG export decline this year compared to last year?
Yes, thanks, Arthur. So looking at LPG, we are not yet seeing a decline in U.S. LPG exports. Indeed, we see a kind of slowdown in U.S. LPG exports, but we've also seen the U.S. target the Chinese market quite strongly over the past few months. So based on the fact that we see lower and lower LNG volumes getting out of the U.S., that could point out to a huge fall in associated gas production and gas production in general that has decreased by almost 10 BCF a day in the US. We could see LPG exports decline, but so far we actually are seeing 130,000 barrels per day higher LPG exports this year compared to last year.
Thank you, Humayun. We'll stop the webinar here. We have some additional questions, but we will send you the answers by email. Thank you very much for being with us today, and we'll see you in the next webinar. Have a good weekend. Goodbye.